No, definitely. Thank you for that warm welcome. And I suppose my area of focus for the purposes of this discussion is Southern Africa. So more broadly, we believe that several headwinds are definitely coming together to create a more challenging macroeconomic environment compared to what we envisioned at the start of the year. And across the Southern Africa region, we expect real GDP growth to moderate to 2.4% on average, of course, largely dragged down by a particularly weak outlook for South Africa, where growth is expected to tick in closer to that 1.5% mark for this year. So for the region's largest economy, of course, the growth slowdown reflects fading base effects, higher inflationary pressures, and persistent structural constraints such as power shortages, the burden of state-owned enterprises, higher borrowing costs, and of course, elevated unemployment. But certainly across the world, especially in the emerging market space, a lot of economies are struggling with a three-pronged crisis, right? The lingering impacts of the pandemic and related supply chain disruptions, definitely tighter financial conditions, broadly reflected in the increase in also sort of food, fertilizer, and energy prices, which have been exacerbated by the impact of the Russia-Ukraine conflict. But in our view, the Russia-Ukraine conflict for many countries has five main points of exposure. That's trade exposure, inflation, investor sentiment, financial market exposure, and of course, second-order political and security risks. So as sentiment weakens and flows rotate out of risk assets, emerging markets will continue to see quite high volatility with a bearish tilt. Another key area to watch that we believe is an underappreciated risk is slowing growth in China, largely as a result of stringent lockdowns. And of course, this will compound the existing downside pressures there. So since China is a key trade partner to the region, a key global manufacturing hub and critical to global supply chains, these factors, of course, could exacerbate economic risks and inflation for longer across the world. But on the upside, the Southern Africa region will benefit from stronger commodity prices in the near term, especially in your sort of mining sectors, your platinums, your PGM rather, gold, manganese, diamonds, chrome, and oil and gas that will, of course, support exports where higher oil and gas prices will especially benefit markets such as Angola. But of course, while commodity exporters will benefit from higher prices in those categories, the high import reliance for food and refined fuels in particular will, of course, weigh on trade balances, especially since a lot are net energy importers. And this will continue to add inflationary pressures with potential second-order risks of social unrest. There are other few bright spots to be aware of. I want to highlight Mozambique that will see growth in the region of around 5% this year, of course, driven by investments. We've seen Eni's LNG project is expected to deliver first gas this year. And of course, this is going to turn Mozambique into a net LNG exporter. But of course, there remain some risks related to the underlying business environment there, related to insurgency in the northern regions of the country when it comes to the sort of longer term LNG project pipeline. For countries like Mauritius and other tourism reliant markets, of course, the recovery in the tourism sector will be quite growth supportive to some extent, but it's been underwhelming, and we expect tourist arrivals in the region to remain below pre-pandemic levels still this year. So especially given prevailing risks in key source markets, of course, the lingering impacts of the pandemic. On the policy side, across the region, we believe that authorities just simply don't have adequate tools, adequate policy space to alleviate the fallout, to kind of cushion the economic blow to populations across the region. And it's important to note that global food and energy prices were rising even prior to the Ukraine conflict. And on the whole, higher inflation across the region will, of course, reinforce the hawkish stance taken by most central banks, especially in South Africa. We expect the SARB to continue to progressively raise rates this year, especially as the US Fed continues to tighten. And of course, we expect higher borrowing costs to weigh on business sectors in the region and fiscal outlooks alike. And across the region, sort of costly subsidies, support for state-owned enterprises, also add pressure to government finances at a time when debt servicing costs are already quite elevated. So, of course, against this very tough macro backdrops, there are also political risks. There's several elections and political events on the cards in the near term, spanning from Lesotho, Mauritius, South Africa this year, and of course elections and instability in risk hotspots like Eswatini and Zimbabwe next year. So this kind of underlines some of the political risk flashpoints in the region, and this will likely also serve to kind of slow the pace of pro-business reform momentum.